Alright, let's talk about something that sounds incredibly dull. I know, accounting, but stick with me. Because tonight we're diving into accrual accounting. It's like the difference between knowing you a $5 bill and knowing you're 50, but also 30. Now, why should you care about this? Because accrual accounting is the financial equivalent of a truth serum. It forces companies to be honest about their performance. It's about what they've, even if the check is still in the mail. And it's about what they, even if they're conveniently forgetting to pay that bill. So buckle up, because we're about to make accruals, well, not, but at least understandable. So what is this dark magic, this accrual accounting? It might sound like a complex term, but it's actually a straightforward concept that can transform how you view your finances. At its core, it's actually quite simple. Accrual accounting is based on the idea of recording revenues and expenses when they are earned or incurred, not necessarily when the cash changes hands. It operates on a revolutionary idea called the matching principle. This principle ensures that revenues and related expenses are recorded in the same period, providing a more accurate picture of financial performance. Revenues are recorded when they are earned, reflecting the true economic activity of the business. Not necessarily when the cash lands in the bank account. This can sometimes be confusing, but it's crucial for understanding the real financial health of a business. And expenses are recorded when they are incurred, not just when they finally, reluctantly part with their precious cash. Not just when they finally, reluctantly, part with their precious cash. This method helps in matching the cost of goods sold with the revenues they generate. Think about it like this. Imagine you're a freelance graphic designer. You work hard and finish a brilliant logo for a client in January. You finish a brilliant logo for a client in January. Under accrual accounting, you recognize that income in January. Under accrual accounting, you recognize that income in January, even if the client doesn't pay you until April. Even if the client doesn't pay you until April. This way, your financial records reflect the work done and the revenue earned in the correct period. The same logic applies to expenses. You record them when they are incurred, not when you pay them. It's about linking cause and effect, ensuring that the financial statements reflect the true economic activities of the business, or in this case, consumption and cost. This approach provides a clearer, more accurate picture of your financial health. Now you might be thinking, this accrual thing sounds complicated. Isn't there an easier way? And yes, there is. It's called cash accounting. It's the simpler, more straightforward sibling in the accounting family. Cash accounting is exactly what it sounds like. You record income when cash comes in, and you record expenses when cash goes out. Just like that. Simple. Easy. Like a toddler's understanding of economics. Me have money now? Good. Me give money now? Bad. It's beautifully uncomplicated, which is precisely its biggest flaw. Because business, my friends, is rarely that simple or straightforward. Unless your business is, I don't know, selling lemonade for one day. Section 4. Accrual in action real-life financial detective stories, minus the Deerstalker. So let's get down to brass tacks. How does this accrual stuff work in the wild? Let's look at accrued revenues. This is when a company has earned money but hasn't been paid yet. Imagine an electricity company. You use power all through July. They've provided the service, fulfilled their end of the bargain, they've that revenue. They don't wait until you grudgingly pay your bill in August to recognize it. They accrue it in July, creating an account receivable, a fancy term for an IOU from you. This shows their true July performance, not just their August cash collection skills. Then there are accrued expenses. Section 5. A funny thing happened on the way to the balance sheet. The case of Barry's Bewildering Bakery. Now, for a story. Let me tell you about Barry. Barry ran Barry's Bodacious Buns, a small artisanal bakery. Barry was a fantastic baker. His sourdough, legendary. His croissants, flakier than a politician's promise. But Barry, bless his flour-dusted heart, was a cash accounting kind of guy. If the till is full, I'm rich. If it's empty, I'm broke, he'd declare, usually while covered in dough. This worked, sort of, for a while. Until the Great Town Festival of 24. Barry got a massive order 500 artisanal loaves for the festival committee. Section 6. The Glorious Perks. Why businesses secretly or openly adore accrual. So, apart from saving artisanal bakers from existential dread, why is accrual accounting so important? What makes it the darling of the business world, both for small enterprises and large corporations alike? What are the tangible benefits that make businesses endure this seemingly complex system? Why do they choose accrual over the simpler cash accounting method? Well, first and foremost, it provides a comprehensive and accurate picture of a company's financial health. This is not just about knowing how much cash is in the bank. It's about understanding the true financial position, including all the money that's owed to the company and all the money the company owes. It's like the difference between a blurry selfie taken in a dark room and a professionally lit portrait. One is a vague impression, the other shows you what's really going on. This clarity is crucial for making informed business decisions. Should we expand our operations? Should we hire more people? Can we afford that gold-plated office stapler? This accuracy is crucial for making informed business decisions. Should we expand? Should we hire more people? Can we afford that gold-plated office stapler? Accrual-based reports give managers the real data they need, not just a snapshot of the cash balance. This means they can plan better, allocate resources more efficiently, and avoid nasty surprises. Secondly, accrual accounting is beloved by investors and lenders. Yes, beloved! They appreciate the transparency and reliability it offers. Imagine you're thinking of investing your hard-earned cash into Shiny Object Corp. You want to know if they're actually profitable, or if they're just good at collecting cash up front for services they haven't delivered. You want to know if they're actually profitable, or if they're just good at collecting cash up front for services they haven't delivered. Accrual accounting helps you see the real picture. Accrual statements show you the company's earnings and obligations. This means you can assess the true financial health of the business. Earnings and obligations. It helps you assess risk and potential returns more reliably. In the end, accrual accounting provides a clearer, more accurate picture of a company's financial health, which is invaluable for making sound business decisions. Section 7. The big picture: transparency, truth, and slightly less terrifying spreadsheets. So there you have it. Accrual accounting. Not as terrifying as it sounds, right? Maybe a little bit. But once you get the hang of it, it's like riding a bike. You might wobble at first, but soon enough you'll be cruising. It's essentially the grown-up, responsible adult in the room of financial reporting. The one who keeps everything in check and ensures that nothing slips through the cracks. While cash accounting is like that friend who only talks about what they bought today, accrual accounting is the friend who plans for the future, remembers the past, and keeps track of everything in between. Accrual accounting considers the past, present, and future commitments. It's about seeing the whole picture, not just a snapshot. It's about recognizing that economic events, earning revenue, incurring expenses, are the real story, the narrative that truly matters in the financial world. Not just the jingle of coins or the rustle of notes. It's about understanding the underlying activities that drive those cash flows. It's the detective that uncovers the true financial narrative of a business, piecing together clues from invoices, contracts, and timesheets. Piecing together clues from invoices, contracts, and timesheets. It's a meticulous process, but one that reveals the true financial health of a business. The core idea, the matching principle, is elegant in its simplicity. Match the efforts, expenses, with the rewards, revenues, in the correct time period. Match the efforts, expenses, with the rewards, revenues, in the correct time period. This principle ensures that the financial statements reflect the true performance of the business. This gives you a clear, consistent, and comparable view of performance. It's like looking at a well-maintained garden, where every plant is in its right place. It strips away the distortions that can arise from the erratic timing of cash flows. It's about clarity, consistency, and a true reflection of financial health.